If you're a high-income Canadian, here's the truth. Using RRSPs and TFSAs the wrong way could mean paying way more to the CRA than you need to. And having the right mix could save you hundreds of thousands of dollars in taxes over your lifetime. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial, and we build strategies that integrate tax planning, corporate structures, and smart investing. So today, I'm going to walk you through how RRSPs and TFSAs compare and show you how our investment platform, which is called Harness, ensures that your money is managed with transparency, stability, and a fiduciary care. Understanding RRSPs and TFSAs. So when it comes to wealth building in Canada, two of the most powerful registered accounts are Registered Retirement Savings Plans, which is RRSPs, and the Tax-Free Savings Account, which is your TFSA. So both offer tax advantages that help your money grow faster than it would in a regular non-registered account. But the way they work and the way that high-income Canadians should use them is very different. So RRSPs, they give you tax deferrals and retirement planning, right? The RRSP is designed as a tax-deferred retirement account. So every dollar that you contribute into the plan reduces your taxable income in that year, which could result in a significant tax refund if you're in a high tax bracket. So inside the RRSP, your investments will grow tax sheltered until you withdraw them in retirement. And then at that point, those withdrawals are fully taxable as income. So this makes RRSPs particularly attractive for high-income earners who are in the top tax brackets today, but expect to retire in a lower tax bracket later. So for example, if you're at the 48% marginal tax rate now, but you're expecting to withdraw later and be in the 30% highest marginal tax bracket later, then those tax savings over time can be substantial. The RRSP allows you to carry forward your unused contribution room, and it can be paired with strategies like a spousal RRSPs to further reduce your household tax. Now let's switch gears to the TFSA. So the tax-free growth and really unmatched flexibility. The TFSA, on the other hand, it flips this model, right? The contributions come after tax. So you don't get a deduction up front, but any growth, any withdrawal, any income earned inside the account is 100% tax-free. So this includes all types of income like capital gains, dividends, interest. If you're a high-income Canadian, the flexibility of the TFSA is just as important as the tax benefit. So you can withdraw the money at any time for any reason, whether it's another investment opportunity or a down payment, or you bridging a liquidity gap, or just doing something without having to pay taxes and penalties. So now, unlike RRSPs, the withdrawals, they free up additional contribution room in the following year, which keeps the account endlessly reusable. So just for an example, if you have a TFSA and you take out $20,000 this year, you don't lose that room. You can put the $20,000 back next year, which is a huge advantage for the TFSAs. So now, which account is right for you? How do you choose the right account if you earn a high income? So both of them, the RRSP and the TFSA, they're powerful tools, but really the choice depends on your income type, your corporate structure, your long-term goals. If you're an incorporated professional and you're paying yourself dividends, your RRSP contribution room might be limited, which makes TFSAs more attractive. If you're a business owner and you're paying yourself a high salary, the RRSPs could provide greater immediate tax relief. And if you're planning retirement income, the right balance of both RRSP and TFSA can reduce your lifetime taxes while preserving a lot of flexibility. So what do you need to know as a high-income Canadian? Well, really, for most Canadians, the RRSPs and the TFSAs are really just straightforward savings and investment tools. But when you're earning a lot, or you're incorporated, you own a business, the decision becomes a little bit more complex. So it's not just about putting money away, it's choosing which account you put it into. What's the right account to maximize the tax, your savings today, to maximize your long-term growth, and to integrate with your overall corporate estate plans and retirement plans. So how does it look like when you take the money out later, right? So are you saving taxes now? Are you saving taxes later? Are you saving taxes the whole time? And can you potentially get yourself dinged? So some of the advantages of the RRSP, especially if you're earning a lot of money, it's especially powerful when your income puts you into the top marginal tax brackets. So the contributions could generate you a substantial deduction against your taxable income, which could give you an immediate tax relief or tax refund, depending on how much you're putting in and depending on how your marginal tax rates work. But if you're expecting that your income and your tax bracket is going to be lower in retirement, then this tax deferral create a long-term advantage. So let's say you're saving today and you're at the top marginal tax rates like we talked about, say you're 48%. You may only pay 25 or 30% when you withdraw in retirement if your income is significantly less. So if you're a professional in your peak earning years, this can create hundreds of thousands of dollars in lifetime savings. And let me just explain how the RRSP deduction works, right? So the way that RRSP works is your contributions get reduced from your income. So say your income is $100,000 and you put $20,000 into your RRSP. The benefit this year is that your income will be $80,000, right? So you had your 100 minus the 20, you're going to pay taxes on the 80. So you're saving the taxes on that 20. And this could create either a tax savings or it could create a tax refund. So as far as TFSA, and what's the advantage of the TFSA? The TFSA shines in retirement planning because the withdrawals are totally tax-free. So they don't count towards your taxable income. And this helps protect you against clawbacks from other government benefits like your OAS, your old age security, or you have your GIS, your guaranteed income supplement. So this is especially important if you're a higher income Canadian who wants to preserve your benefits eligibility while also keeping your taxable income low in retirement. So the TFSAs also provide estate planning advantages. So the assets in your TFSA can transfer to a spouse or beneficiary tax-free, and they can avoid that full taxation that you would get with an RRSP or an RRIF, like a RIF. Now, the income type matters. So one of the most overlooked factors in how your income is structured, right? The RRSP contribution room is based on what's called earned income. So this would be your salary or your self-employment income. So if you're primarily paying yourself dividends, you don't get extra RRSP rooms for dividends. So your total RRSP room can be limited, or you might not even have any if you've paid yourself dividends the whole time, which there makes the TFSAs more appealing because the TFSA, you get TFSA room every year regardless. You just have to exist as a Canadian. So if you're an incorporated business owner, this is an important distinction on how do you pay yourself. So unless you do deliberately pay yourself a salary, you might not be creating RRSP contribution room, and you might not be creating enough RRSP contribution room to make the account worthwhile. So this is something you want to talk to your accountant about, whether you're paying yourself a salary or a dividend, and the advantages or the disadvantages of both, right? There's no one right or wrong, like you should for sure pay yourself dividends or you should for sure pay yourself salary. It really depends on your situation. And then there are also other corporate planning considerations. So if you're incorporated and you're deciding, do I put the money in the RRSP or the TFSA, then there's an extra layer of things to think about. So to fund your TFSA, you need to withdraw after-tax income from your corporation. So this might feel less efficient now. Over the long term, that tax-free growth inside the TFSA, if you've made good investment decision, should outweigh the cost of paying the taxes now. So again, especially if you're investing in growth-oriented assets that are going to compound over time, over decades, hopefully. Meanwhile, the RRSP can reduce your personal taxes now, but eventually they're going to create taxable withdrawals. So the optimal choice really depends on if you're looking for that tax savings today or whether you're looking for the tax savings tomorrow or years from now, right? And again, there's no one answer to this. You would want to work with somebody, especially if you're earning a higher income and especially if you're incorporated. You probably want to be making this decision on a year-by-year basis, depending on what your income is that year and depending on your situation that year, of how much you're putting in your TFSA, how much you're putting in your RRSP, or are you putting anything into those at all? So some smart strategies when you're earning this high income as a professional. So if your income is high now, but you're expecting it to be lower later in retirement, then the RRSPs make a lot of sense because you can capture the large deduction today when your income is high, and then you withdraw later when your income should be lower in retirement. So you're going to save high taxes today and pay lower taxes tomorrow if everything stays the same. If your income is high today and you're planning on your income staying high in retirement, then the TFSAs make a lot of sense since those withdrawals are tax-free when you take them out later. So this protects you from the high taxation in retirement, and it can also provide estate planning advantages, right? So if you're planning on making a lot, or if you are making a lot of money now and you plan on continuing to make a lot of money in the future, so this would be for people who've, say, got investments that pay them, or maybe you've got a bunch of rental properties, or maybe you own a building or something and you're like, well, this building is going to keep paying me regardless if I work or not. So I'm going to always have a high income. So TFSA makes a lot of sense there because you don't necessarily want to tie up your money in an RRSP and you're withdrawing it later when you're supposed to be withdrawing it at a lower tax rate, but you're not going to be at a lower tax rate because you make too much money. Champagne problems is what we call these. Probably the best idea usually for most successful entrepreneurs is as a combination, right? So for most Canadians, if you're at that top part of the income scale, you do both. RRSPs get you the immediate tax relief today. TFSAs get you that tax-free growth and that liquidity, and you get the long-term flexibility and the ability to withdraw tax-free at any time. And now how do you structure these accounts? So if you're incorporated, you want to maybe think about or talk to your accountant about paying yourself enough salary to generate RRSP room while also maximizing your TFSA contributions every year. So having a blended approach can balance tax relief today, tax-free growth over decades, and your tax-free or tax-advantaged withdrawals in the future. And the bottom line is you need a coordinated strategy, right? And if you don't have a coordinated strategy, many high-income Canadians can overpay the CRA and they can limit their long-term wealth building potential, right? The key isn't really choosing, do I do RRSP or do I do TFSA in isolation? It's designing the plan that integrates both of these into your wider strategy, into your corporate strategy, your personal strategy, your estate strategy, your cash flow strategy over time, right? You're probably going to need both, and you're probably going to need one more in 1 year, and you're going to need another one more in another year. It really depends on what your income is saying at that time. So how do we fit into this picture? And also, how does our partner, Harness Investments, fit into this picture and help you to invest smarter? So deciding between the RRSP and TFSA, that's part of the battle, right? The real question is, so once you've chosen, I'm going to put this money into my RRSP or into my TFSA, how do you manage the funds? Like, what are you investing in? Tax-efficient strategies lose their power if the underlying investments don't perform or if they're not properly structured. So that's why we don't just help you decide where to save. We help to make sure that the money is saved and invested intelligently. So in order to accomplish this, we use the team at Harness Investment Management. They're our back-end investment platform. It's designed for Canadians who want this institutional level portfolio management with the accessibility and the transparency of a modern online platform. Everything is digital. And here's really what sets it apart. So it's a diversified, professionally managed portfolios or SMAs, separately managed accounts. So your RRSP, your TFSA, your corporate accounts, your non-registered accounts, they're invested in a broad mix of asset classes tailored to your risk tolerance and tailored to your long-term goals. So the diversification helps to smooth the returns, helps to reduce volatility over time, and they're professionally managed by professional portfolio managers who have, our next point, a fiduciary duty and client-first standards. So Harness has a fiduciary standard, which most advisors in Canada do not have. I think only about 4 or 5% of advisors in Canada actually have a fiduciary duty. What does fiduciary mean? It means that every decision that they make must be made by law in your best interest. So like I was saying, this level of responsibility is not something that every advisor in Canada has and is not legally bound to uphold. So It is a huge safeguard for high-income professionals who can't afford to have bad advice, right? Because you've got way more at stake. Then we want to talk about transparency and we want to talk about real-time control. So with this Harness investment management platform being a digital platform, you have 24-hour, 24/7 online access. You can deposit funds electronically, make withdrawals electronically. You can see your performance. You can view transactions in real time. You're never in the dark about where your money is and what your money is doing and how it's performing. Harness also has proven risk management and stability. So when the markets are turbulent, their approach has demonstrated resilience. So for example, in a period where the S&P 500 went down by almost 10%, Harness's portfolios went down by about 1 or 2% because they've got a disciplined risk management and a diversification strategy. So the kind of downside protection is really valuable for business owners who can't afford significant portfolio losses and economic shocks that are outside of their control, right? So a lot of our business owner clients come to us because they don't want to lose money. They say, I can make more money in my company. So these investments, I don't need them to make as much as possible. I need them to be as secure as possible. So I will make the money. You make sure you don't lose it. Another thing that this gives us, actually, that sets us really apart from a lot of people in Canada is access to institutional grade strategies. So through the partnership with Purpose Investments, Harness provides access to advanced investment tools, which would be private equity opportunities, structured products, and then low-fee institutional grade portfolios. So this is the same thing that like pension funds use. This allows high-income Canadians to invest with this sophistication like large institutions, and it helps to keep costs low and efficiency high. Not a lot of financial advisors in Canada can offer that, and we can offer it, and we can stand on it and look you straight in the face and say, yes, this is a good idea. So at Safe Pacific, we see Harness as the engine that powers the RRSPs or the TFSAs that we hold for you, or it could be your corporate account. They handle the day-to-day portfolio management. They handle the rebalancing. What are we choosing to invest in? We act more as your navigator. We coordinate the big picture. We coordinate the tax planning, the corporate structuring, the insurance strategies, the estate planning, how much to put in the RRSP, how much to put in the TFSA. This is where we come in. We're not sitting there picking, you should put this much in Amazon and you should put this much in a gold miner stock and you should put this much into consumer cyclicals or whatever. That's their job, and they have a whole team that does that. So together, this approach ensures that, every dollar is invested wisely, and it's also aligned with your broader financial goals that we work with you with and that we keep in touch with you with over time. Now, if you're incorporated, you own a business or you're an incorporated professional, this combination is really powerful because the RRSPs and the TFSAs, they reduce how you pay tax, or they reduce the tax on the growth. Harness grows the money consistently, and then we integrate everything into a seamless long-term wealth plan that incorporates multiple pieces. And then how do we help, right? So our role is to connect the dots. We help you to choose how much to put into the RRSP, how much to put in the TFSA, or do you put anything into those at all? We ensure that those accounts are managed effectively through our relationship with Harness. And then the real value comes when everything comes together, right? The tax strategy, the corporate structure, the investments, the estate planning. When you have all of that coordinated into a clear roadmap, that's what we do, right? This is where we help the high-income Canadians, the business owners, with the family to maximize their wealth strategy. And what does that look like? It looks like an income structure analysis. So we start by assessing, how do you pay yourself? Is it a salary? Is it a dividend? Is it both? So this determines how much RRSP contribution room you have and whether the RRSP takes priority or a TFSA takes priority this year. If you're incorporated, this is often the deciding factor on how to allocate the savings. We also give you a balanced and a customized planning. We don't just look at this year's taxes. We create a plan that integrates your RRSP, your TFSA, your corporate investments, your non-registered accounts into your long-term goals. So this is planning for your retirement. This is planning for any purchases you have coming up. This is managing your tax brackets across decades. This is making sure your estate plan is aligned with all of this. This is making sure your estate plan is written. And then harnesses investment management, with them as the investment engine. They are making the investment decisions. We make sure the money inside the RRSP or the TFSA or your corporate accounts, your personal accounts, is managed with fiduciary care. That's really important. With the proven risk management strategies. So when the markets crash, you don't follow. And with transparent, low-cost portfolios. So the majority of the things that are held inside these portfolios would be either individual stocks or ETFs and stuff, which generally come with lower cost to holding it than if you're looking at, say, like a mutual fund or a segregated fund. Not that there's anything wrong with mutual funds and segregated funds. They all play a role in the Canadian economy, and we love all of them, and we have all of them. But really, we're able to offer low-cost portfolios. And so this ensures that you're not just saving in the right account, but you're growing your wealth with consistency and with that downside protection. And then another place that we help is integrating across your financial life, right? So we tie everything together. Your investment accounts are linked. You've got your corporate planning. You've got your insurance strategies. You've got your shareholder agreement done with, if you've got partners, you've got your estate plan done. And this is what prevents having gaps. This minimizes unnecessary taxes, and this ensures that your wealth grows smoothly, but also passes smoothly to the next generation if leaving that legacy is important to you. So in short, we're the quarterback of the financial plan, I guess, right? And we make sure that every part of the plan is strong on its own, but also working in harmony. And this is the difference between simply saving money and building a true generational wealth strategy, right? And this is not something that most financial advisors do. This is really kind of like our special sauce in being able to quarterback all of these things confidently. So final thoughts, because this is getting kind of long. There is no one-size-fits-all answer in the RRSP versus TFSA debate. I know this is the internet, and I'm supposed to tell you that this is the only one that you should do and the other ones are crap, because then that will get me a lot of rage comments and it'll get me the engagement and more people will watch the videos and all the algorithms will say, yeah, sell this one. But that's not how we operate. We assume that you're smart enough, that you don't need to be rage engaged like this. So really the truth is most high income Canadians should use both, but in different ways. And the answer this year might be different than next year because your situation is going to be different, right? So it depends on your income. It depends on your tax situation. It depends on your long-term goals. It depends on your family situation. What we're going to do to set up for somebody who's got a 2-year-old kid versus somebody who's got a 30-year-old child is different. Somebody who's 20 years away from retirement versus somebody who's retiring in 2-3 years, totally different, right? Somebody whose business is making $500,000 a year or somebody whose business is making $500 million a year, totally different, right? The key is structure. It's putting the right dollars into the right accounts. It's investing them in the right platform. It's having trusted people. It's coordinating the strategy with your overall financial plan. And it's doing it properly so that it reduces the tax drag. It increases your long-term growth. It builds wealth that lasts and that's solid and that you can depend on and that you can pass down to the next generation. And this is what we do. This is what we help you to do, right? If you're a high-income Canadian, if you're a business owner, if you're an incorporated professional, this is really, and you haven't started saving in your RRSPs and your TFSAs, like you really do need to get started, and you want to do it in an optimized way. Now, if any of this sounds like something that you want to do and you want to get started with, how do you do that? Super simple. Go to our website. It's safepacific.com. Really easy to spell. We work across Canada, and I'm going to link safepacific.com underneath this video or somewhere on this page. You can click on it. And when you get there, there's so many links that you can click to either book directly in our calendar, or you can send us a message and somebody will reply back to you, and we'll set up a time to meet and see how do we integrate these types of accounts with your corporate planning, with your estate goals. How do we introduce you to our harness investment platform so that they can invest with a fiduciary duty and have your money growing over time so that it's meeting your goals today, it's meeting your goals tomorrow, it's meeting your goals in 10 years, 20 years, during retirement, when you have kids, when you don't have kids, and when you pass on, and if there's the estate piece to think about. So your next steps is to click on safepacific.com and send us a message or book a time in our calendar. But before you go, if you got any value today, if you learned a little bit about how RRSPs and TFSAs work for higher income Canadians or incorporated Canadians, then please do all those things that the algorithm likes. Please do all the things that tell the robots to share this video with more people that are just like you. That includes click like, click share. If you want to argue with me, leave it in the comments. We love that because it helps the videos get more engagements. Do all those things. And if you haven't subscribed to our channel, hit subscribe. We post one of these videos every single week, usually on a Tuesday, and I would love for you to watch the next one. That's it for me today. I'll see you next time.